One of the standout segments in the market over the past few years has been tech, in particular, big tech, in particular, FANG. The acronym used to describe Facebook, Amazon, Netflix, and Google, which have basically gone nowhere but up for years. You hold them as a portfolio, you've done extremely well. So what's next for FANG, and should we even be focused on FANG? Goldman Sachs came out and said that FANG is actually not what we should be focused on. They have a new acronym. But all of this faith in tech and FANG was shaken last week when we had a sharp sell-off that continued into this week. What does it mean? Are we in a new tech bubble? Is this the beginning of the crash? Let's look at some data on that. First of all, to go back to Goldman, basically what Goldman says is actually we shouldn't be talking about FANG, Facebook, Amazon, Netflix, and Google. We should be talking about Facebook, Apple, Amazon, Microsoft, and Google, leaving aside Netflix and another N that they invoke, NVIDIA. But no matter what you focus on, where are we in valuations? Well, Goldman points out something very important is if you go back to the real tech bubble in 2000, my tech bubble, I was right in the middle of it, and you look at the top 5 tech stocks in those years, what they were worth and where they were trading, they were worth collectively about $2 trillion, a huge amount of money, but they were trading collectively at about a 60x PE, so an extreme price earnings multiple. You look at today, the 5 big stocks that Google focuses on, we're trading at about a 23 PE multiple. And those who know market history will look at that and say, well, hey, 23 multiple is still pretty high. There's room to sell off, and there's no question that that is true. And in fact, I want to show you a chart that really highlights that, but the chart also highlights that we are nowhere near in the tech sector where we were during the bubble years. So let's take a look at that. Basically, this chart goes back to the 1980s. It looks at 2 things. The blue line is showing you PEs. The yellow line is actually showing you enterprise value to sales. The difference between the two captures the profit margins. What you see is that on a PE basis, way over here, we're actually below the value that we were in back in the tech bubble, certainly, but also the average value. But on the enterprise value, we're above it. And this is because some of the tech companies like Apple and Facebook are just so spectacularly profitable now that on an enterprise value, they're more expensive. But most importantly, if you go back, this is the tech bubble. We are nowhere near that. And in fact, talking to a very disciplined value investor who manages hundreds of billions of dollars earlier this year, I was asking about tech stocks. Why are people focused on them? Why do you keep buying them at elevated prices? And he said, look, if you look at the whole market, prices across the market are elevated. And when I look at a cereal company that is trading at 20 times earnings and has no growth prospects ever, pretty much, unless we suddenly decide to eat a lot more cereal, and I compare that multiple to the multiple on a Facebook, which I think can grow earnings at 20% a year for many years, I say, you know, looking at Facebook, it looks relatively cheap, and 23 for a stock like that isn't that much. So that is why these stocks have been such big winners over the last few years. Portfolio managers are looking across the market. They're trying to figure out where the growth is. This is where the growth is, and it has been very scarce everywhere else. So they've been willing to pay up for that. And looking at it now, what they conclude is that even with the run in these stocks, the tech sector isn't historically that expensive. So seems like it might continue. The sell-off on Friday and into this week was obviously scary, but on a valuation basis, we are nowhere near where we were in the tech bubble. So you can at least rest assured if you own these stocks of that. What you want to watch out for is something like what happened with Cisco, which was the most-owned stock back in the tech bubble, trading at something like 75 times earnings at the peak. Cisco is still a tiny fraction of the value it was in 1990 and 99 and 2000. You want to avoid that. But when you're buying into big companies that seem to have good prospects at least more reasonable valuations, still extended, but more reasonable, ultimately you have a little more safety as a result. So one hopes not the end of FANG or the tech bubble. That's the bottom line.